Today is a very important lecture, which is the journal entry. Now, journal entry is going to be the basis of all your accounting in future. Your 11th, your 12th, your degree, whether if you even choose to do CA in the future, this is your foundation, the journal entry. Let's not waste much time and get right into it. Before we understand how to write a journal entry, we must know what an account is. Like in the previous lectures, I explained, an account is nothing but a summarized record of all transactions relating to one particular head. For example, all transactions related to salaries will be recorded in one place, that is the salary account. Similarly, if all transactions that have taken place in cash will be recorded in one particular place, which will be called the cash account. So here on your screen, you can see a pro forma of how an account is drawn. In the next chapter, ledgers, you will be needing to draw this pro forma. So you have two columns. You have a debit side and a credit side. In simple words, debit just means the left side of the account and credit refers to the right side of the account. An item which is recorded on the debit side is said to be debited, whereas an item recorded on the right side or the credit side is said to be credited. Now the pro forma is you have your date, you have your particulars, details of the transaction, then you have journal folio. When we'll be doing ledgers, you will understand what is journal folio and what is ledger folio. Then we have the amount of the transaction and then similar details on the right side. So you can see the cash account. On your left side, you have all the dates, and then in particulars, you have the details of each account. And then here is the journal folio. So if I want to see the journal entry for cash sale on April 2nd, in my journal folio, I will refer to number 15, where I will find the journal entry for this particular transaction in my account. Cash sale of goods rupees 5,000, money that I have received from debtors 7,000, receipt of commission 2,000, sale of fixed assets 3,000, rent 500. So whatever amount that whatever cash that is coming into the company is being debited, whereas whatever is going out of the company is being credited and is written over here, like your payments for purchases, payments to creditors, payments in salaries, traveling, postage, cartage, etc. And then here we have the closing balance. And at the end of every account, both balances must tally. To further understand how transactions can be classified into debit and credit, we need to understand how to classify accounts. Now, to classify accounts, there are two systems. One is the traditional classification method and one is the modern classification system. Okay? Under traditional classification of accounts, accounts are divided into two. One is your personal account and the other is your impersonal account. Personal accounts are, as the name suggests, accounts of people or persons, individuals, companies, firms, debtors, creditors, capital, drawings, etc. These are all personal accounts. For example, uh, if Ram, if Messrs. Ram is my customer, then Ram is a personal account. And if Messrs. Javeri and Co. are suppliers to my company, then even they will be a personal account for me. Now, personal accounts can further be divided into natural, artificial, and representative accounts. Now, what does this mean? Natural means people who are creations, they are in flesh and blood man. So, accounts of those people are called natural people, natural accounts. Natural personal accounts. For instance, we have a customer by the name of Shyam. Since that person is a real human being, he will be classified under a natural personal account. Under artificial personal accounts, we have corporate bodies or businesses. For example, accounts of a club or a cooperative society or that of a public limited company. As we know, companies are artificial persons. They are not real persons. Thus, those accounts are classified as artificial personal accounts. Then, The third category is representative accounts. Now, these are those accounts which represent a certain person or a group of persons. For example, if rent is due to the landlord, an outstanding rent account will be opened in the books. The outstanding rent account represents the landlord to whom the rent is payable. Now, the accounting rule for a personal account is debit the receiver, credit the giver. In a transaction, whoever is receiving the money, that personal account will be debited. And which personal account is giving the money, that one will be credited. So, debit the receiver, credit the giver. Now, for our next classification, we have impersonal accounts. What are impersonal accounts? Accounts which are not personal. For example, machinery, cash, rent. So, real account and these impersonal accounts can further be divided into two subcategories, that is the real account and the nominal account. Under real accounts basically relate to tangible assets. Real accounts are the accounts which relate to tangible or intangible assets. For example, land, building, investments, plant and machinery, stock, cash in hand. The rule for all real accounts are debit what comes in and credit what goes out. Okay? Debit what comes in and credit what goes out. So if any asset is coming into the business, as assets are real accounts, that particular asset will be debited. Supposing any real account is going outside the business, for example, cash is being paid, so that means cash is leaving our business. Cash will be credited. The rule is debit what comes in, credit what goes out. Now, nominal accounts. Nominal accounts are those which relate to revenues and expenses. So they can be, for example, your salary account, purchases account, interest paid, commission received, etc. And the rule of nominal account is debit all expenses and losses and credit all incomes and gains. So these are the three golden rules of journal entry which you should learn. So these are the three golden rules of debit and credit and the basis and the so these are the three fundamental rules on the basis of which you will write a journal entry. I suggest that you learn these very well. And now let's do a quick tiny quiz. Now that we have seen what real, personal, and nominal accounts are, let's try and identify these accounts into these three categories. Capital introduced. Capital by nature is a personal account. So I will be writing here personal account. Next, drawings. Even this will be a personal account because it is related to the owner and the enterprise. Third one is cash received. Cash received, cash is an asset. So thus it will be a real account. Interest paid is in nature an expense. So it will be considered as a nominal account. Discount received, discount received in our books can be considered as a gain, and all expenses and revenues, losses and profits are classified in the nominal account. Bank account is again an asset, so we will treat it as a real account. Bank overdraft is a loan, and this is a liability that we owe to the bank. Thus, it will be a personal account. Bad debts written off will be classified under nominal account. Okay, what is a bad debt? Bad debts are basically that sum of money which the company is not able to recover from their debtors. So, bad debts written off will be a loss to the business, thus, it will be classified under nominal. Now, outstanding salaries. Outstanding salaries will be a personal account. It will be a representative personal account because salaries are being owed to a group of people. That is why it is going to be representative personal account. Now, what is prepaid rent? Prepaid rent will also come under personal account. Why? Because Since we have paid it in advance, it will be considered as personal account. The next one is purchases account. Purchases account is by nature an expense. It will be classified as a nominal account. Similarly, sales account. Sales means money is coming in, it's revenue. So even this will be classified as a nominal account. Carriage inwards is also another kind of expense, and expenses are classified as nominal account. So carriage inwards will also be a nominal account. Bad debts recovered. Now the bad debt that we thought we weren't going to receive has been paid. That means it is a gain for our company, and all gains, losses, expenses, and revenues are classified as nominal account. Accrued interest. Interest which has been earned but not yet received. That is called accrued interest. This will be classified as a personal account because it represents the bank and we are yet to receive it. Had we received it, had it been interest received, it would have then been classified as a nominal account. Goodwill. For now, know that goodwill is an intangible asset, and all intangible assets and tangible assets are classified as real accounts. Plant and machinery is a tangible asset, so this will be a real account, and so will leasehold property. Real account. I hope you have understood how to classify accounts under personal, real, and nominal. Now, from these following transactions, now let's do a problem in which the following transactions are given and we have to state the nature of the accounts and also state which account will be debited and which account will be credited. Mr. Mohan started business with 5 lakh rupees cash. So his capital, so here only two accounts are involved, capital and cash. Okay. I'm just writing down the accounts involved. So the accounts involved are capital and cash. We know that capital is a personal account and cash is a real account. And what is the rule for personal accounts? Debit the receiver, credit the giver. Okay? Debit the receiver, credit the giver. That is the rule for a personal account. Now, here who is giving the money? Mohan is giving the money and he is giving capital to the business. What is he giving? He's giving capital to the business. So capital will be credited. Now, what is the rule for real account? Debit what comes in, credit what goes out. So what is coming into the company? Cash is coming into the company. So we will debit cash. Let me write it down in the spreadsheet as well so you will get a better understanding. Number one, Mr. Mohan starts business with rupees 5 lakh cash. What are the accounts involved? Cash and capital. What is the nature of these accounts? Real account, nominal account. Now, what will be debited? Cash will be debited because of the rule. What is the rule of a real account? Debit what comes in and credit what goes out. Cash is coming in, so we will debit cash. And personal account, the rule of personal account is capital is being received by the company and that is why it is being credited. So what would be the reason here? Incoming, cash is incoming. And here, capital is being given. Transaction 2. We have purchased goods for cash worth rupees 1 lakh. Okay. Now here there are two assets, two things are happening here. Here we are purchasing goods for cash. So what are the accounts that are being involved? One is purchases account and the other is cash account. Now purchases by nature is nominal and cash by nature is real. So what will be debited? What is the rule of a nominal account? Debit all expenses and losses and credit all incomes and gains. Purchases by nature is an expense because we are paying money to acquire goods. Thus, we will debit purchases and we will credit cash because what is the rule for a real account? Debit or debit what comes in and credit what goes out. What is going out in this case? Cash is going out. So we will credit cash. Expense, and this is an outgoing. The reason. Now what is the third transaction? We have sold goods for cash worth rupees 1,50,000. Now, what are the accounts involved here? Sales and cash, because we have done a cash sale. Now, sales in nature is what? It is revenue. So, we will classify it as a nominal account, and cash is classified as a real account. Here, what will be debited and what will be credited? Sales. Then the rule of the nominal account is you debit all expenses and you credit all incomes. Sale by nature is an income, right? Thus, we will credit sales. And as cash is coming in, we will debit cash. Because what the rule for a real account is debit what comes in and credit what goes out. Cash is coming in, and that is why it is being debited. In the reason, we will put incoming. Sales is income. Now, the next transaction is we have received interest from Ram in cash worth rupees 500. Here, even though the name Ram is being given, it is not material to us because the major accounts that are being because the accounts that are being affected is the interest account and cash account. So, what are the accounts that are involved here? Interest and cash. Ram will not be considered in this case because it is a nominal account. So, interest is a nominal account and cash is a real account. Interest by nature is an expense, but here we are receiving interest. Interest received. So, it is an income for the company. What is the rule of what is the nominal account rule? Debit all expenses and credit all incomes. Thus, interest received will be credited and we are receiving cash. What is the rule for a real account? Debit what comes in and credit what goes out. Cash is coming in, so cash will be debited. Income, incoming. Next transaction. Number 5. We have sold goods to Ashok for rupees 60,000. Here they have not mentioned cash, but they have mentioned the name of the person we are selling goods to. So, in such a case, we need to assume that this is a credit sale. Ashok is yet to pay the company. So, what accounts will be involved here? One will be sales account because we are selling goods, and the next one will be Ashok account. We have because he owes us money. So, sales is a nominal account, is nominal in nature, and Ashok, since he is a real person, will be a personal account. So, how will we treat sales? Sales, it being a nominal account, Debit all incomes, credit all expense. Debit, it being a nominal account, we debit all expenses and losses, and we credit all incomes and gains. Sale is an income, it is revenue. Hence, it will be credited. And what is the rule for a personal account? You debit the receiver and you debit the receiver and you credit the giver. It's easy to remember. Debit is usually written as DR. So remember, debit, receiver, DR. Debit the receiver. In this case, Ashok is receiving goods. So he will be debited. His account will be debited. Here, sales is an income. And the reason, sales is an income. And Ashok is the receiver. The next transaction is we have purchased furniture for cash worth rupees 50K. Okay, so what are the accounts involved? One will be cash, and since we're buying furniture is a real asset, it will be considered. And since we're purchasing furniture will be the other account that is involved. Now, both these accounts are assets, and all assets are real accounts, right? So, by nature, both are real. And what is the rule of a real account? Debit what comes in and credit what goes out. In this case, what is coming in? Furniture is coming in. So, we will debit furniture. And what is going out? Cash. We are paying cash to acquire the furniture. Cash is going outside the company. So, that is why we will credit cash. Furniture is incoming, cash is outgoing. Like calls, incoming, outgoing, incoming, outgoing. Okay. The last transaction is paid wages, rupees 20,000. Now, what accounts would be involved here? Wages and cash. Wages is like a salary that is paid to the manufacturing employees, to the laborers. Laborers are usually paid daily wages, right? They're paid on a daily basis. So that amount, what we pay to laborers is called wage. Now, what are wages? Wages by nature is an expense. So it will be classified as a nominal account. And cash is a real account as it is an asset. What is the rule for a nominal account? We debit all expenses and we credit all gains. So here wages will be debited because it is an expense. And cash will be credited because it is outgoing, it is going out. The rule of the real account. Debit what comes in and credit what goes out. I hope you have understood. Now let's move on to the next kind of classification of accounts, which is called the modern classification of accounts. Now, under this approach, accounts are classified into 5 categories. You have asset accounts, you have liability accounts, you have capital accounts, revenue and expenses. So asset accounts, they refer to all the accounts of assets like land, building, plant, machinery, furniture, patents, inventory, etc. etc. And liability, like the name suggests, it refers to all the liability accounts like creditors, lenders, bank loans, etc. Creditors for expenses. And capital accounts, as the name suggests, it refers to the account of the partners or the proprietors who have invested money in the company. Revenue, these are those accounts these are accounts of incomes and gains, like for example sales, interest received, etc. Expense accounts are those which show the amounts which have been spent or losses incurred in while carrying out the business. For example, purchases, wages paid, rent, etc. Now, what are the rules for this? Now, what are the rules for this type of classification? If asset is if an asset is increasing, it will be debited. Okay? And if it is decreasing, it will be credited. And for liabilities, if a liability is increasing, it will be credited. But if it is decreasing, it will be debited. And capital by nature is the credit account. So if it is increasing, it will be credited. Decreasing, it will be debited. Revenue, similarly, expense also. If an expense is increasing, it will be debited. But if it is decreasing, it will be credited. Let me write it on the board for you for a better understanding. Now, an asset account, it will usually have its opening balance on the debit side, okay? Opening balance. So, if any asset increases, it will be put on the debit side. And similarly, if there is any decrease in the asset, it will be put on the credit side. Okay. Next, we have liabilities. Liabilities, liabilities is opposite to assets, and it will have its opening balance on the credit side. Okay. Thus, any increase in the liability will be put on the credit side, and any decrease in the liability will be put on the debit side. Capital, capital again, it is, remember from the first lesson, we said that it is a internal liability. Liabilities, now we have capital account. Remember, capital is nothing but an internal liability. But in nature, even capital is a liability. It's just that this is owed internally, owed to the owner. So, even capital will have its opening balance on the credit side, and any increase in capital will be credited, will be put on the credit side, and any decrease in capital will be put on the debit side. Now, expenses. Expenses. What is expenses by nature? They will have their opening balance on the debit side, and if any expense increases, that will be debited. But if the expense decreases, it will be credited. And revenue will be the opposite of expense. It will have its income or revenue. Okay, income slash revenue, it will have its opening balance on the credit side, on the credit side. So any increase in income will be put on the credit side, whereas any decrease in the income will be put on debit. That is the rule over here. When we do an example, you will understand it more thoroughly. So just remember one thing, assets, their opening balance will be on the debit side. So any increase will be debited. Similarly, liabilities will have an opening credit balance, capital will also have an opening credit balance, so will income, and expenses will have opening debit balance. So what? So whenever there is any increase in the account, that will be added to the corresponding side. So if it is a debit type of account, any increase will be debited. And similarly, if it is a credit account, any increase will be credited. Now, let us see an illustration. This is quite a big one, and it will really clear up all your concepts. Analyze the following transactions and state the nature of accounts and state which account will be debited and which account will be credited as per the traditional approach. Okay, they have written traditional approach here, but we will do the modern approach as well. Okay, we will do both. So first let's go with the modern approach since we just read that concept. What was the modern approach? Modern approach said that accounts can be classified into five types: assets, liabilities, capital, expense and revenue. So let's see transaction number 1. Dinesh has started his business with cash worth rupees 5 lakhs. So the accounts involved here are capital and cash. Capital is in nature, capital again, and cash is an asset. So this will be a this will be an asset account. Now how does this affect the accounts? Capital is increasing because we are newly injecting capital into the business, and also cash is increasing. What will we debit? Remember, assets have a debit balance, debit opening balance, and here cash is increasing. So an increase will be debited. We will debit cash 5 lakhs. And here we will credit capital 5 lakhs. Number 2, borrowed from Naresh rupees 1 lakh. So we have borrowed cash of 1 lakh rupees from Naresh. So this means we have created a liability from Naresh. So what are the accounts that are being involved here? One will be cash and other one is loan from Naresh. Cash by nature is an asset and the loan from Naresh in nature is a liability. Here our cash balance is increasing and so is our liability. If an asset is increasing, we will put it on the debit side. Worth how much, to what extent? To the extent borrowed, that is 1 lakh. And here our liability is also increasing. If a liability increases, remember liabilities have opening credit balance. So any increase in liability will be put on the credit side. Credit rupees 1 lakh. Now third transaction. We have purchased furniture for rupees 20,000 in cash from Raj Furniture House. Since we have paid money, we have paid for the furniture in cash, the name of the furniture house is immaterial. However, if we had purchased the same furniture on credit, then we would mention the name of the furniture seller in our books. So what accounts are involved here? Furniture and cash. Okay, furniture and cash. Now in nature, both are assets, but here furniture as an asset is increasing. Okay, and our cash is decreasing because we are paying cash to acquire that furniture. So whatever asset that is increasing will be debited. And how much is our furniture worth? 20,000. Here our asset is decreasing, cash is decreasing. We paid 20,000 for the furniture. So our cash is lesser by 20,000 and thus we will credit it. Fourth, purchased furniture from Delhi Safe for 40,000. So same like above. We have furniture, we have. Okay. So, purchased furniture from Delhi Safe for 40,000 rupees. Now, see, in this transaction, unlike the previous one, they do not mention cash. That means it has been purchased on credit. So, now we will have to incorporate the name of Delhi House in our book, Delhi Safe in our books. So, furniture is an asset and Delhi Safe is a liability because we owe money to the furniture store. Asset is increasing, so that will be debited. And here, debited to the extent of 40,000. And in this case, Delhi Safe, our liability is also increasing. And and how do we treat an increasing liability? We credit it. Why do we credit liabilities? Because liabilities have their opening balance on the credit side. They are by nature credit accounts. Number 5. We have purchased goods for cash for rupees 15,000. So here two accounts are involved: purchases and cash. Purchases and cash. Purchase Purchases is an expense and cash is an asset. So now that we are purchasing, our expense is increasing and asset is reducing, decreasing, because cash is going out to buy that particular good. So expense is increasing, and expense by nature is a debit account. Okay, it has an opening debit balance, so that is why any increase will be put on the debit side, and thus it will be debited. And cash is also a debit account, but it is decreasing, and any decrease in the debit side, any decrease in an asset will be shown, any decrease of an asset will be shown on the credit side. So 15,000 will be credited. Number 6, we have purchased goods from Mahesh for rupees 30,000. Here again note, they have not mentioned cash. That means these goods have been purchased from Mahesh on credit. So two accounts again will be involved. One is purchases account and another is Mahesh account. Purchases is an expense account and Mahesh is a liability. Here my expense is increasing and my liability is also increasing. So expense by nature again is a debit account. It has an opening debit balance and expense is increasing. So we will debit 30,000. And liability is also increasing. Liabilities by nature are credit accounts, and any increase in credit account will be credited. So 30,000 is credited. Number 7, we have sold goods for cash to Karim for rupees 25,000. Okay. So we have two accounts here. We have cash because we are selling it on cash. Okay, so it's a cash sale. We don't need to record Karim's name. And we have sales. Now cash in nature is an asset and sales is an income. Here our asset is increasing, cash is coming in, and sales are also increasing. Our income is also increasing. Asset is a debit account, debit balance is increasing, so it will be on the debit side. Sales is an income, it has a credit balance, it has an opening credit balance. So any increase in the credit in a credit so any increase in income in a so any increase in a credit account will be shown on the credit side. That is why we will put sales on the credit side to the extent of 25,000. Number 8, you have sold goods to Shyam on credit for 30,000. Now, instead of cash, we'll open an account in the name of Shyam and sales. So Shyam is an asset. Why is Shyam an asset? Because we have to recover money from him. In future, money will come from him. And sales is revenue. Asset is increasing. Sales are also increasing. What is the amount? 30,000. So as an asset is increasing, it will be debited, and revenue or income is receiving, it will be credited. Next is 9. We have received cash from Sham worth rupees 20,000. Okay. So we have cash account and we have Sham account. Here, cash is also an asset and Sham is also an asset. Why is Sham an asset? Like I told you in the previous transaction, he is a debtor. We are going to recover money from him. That is why he is an asset. Now he is paying us money. Our cash is increasing, and since he is paying us money, now the amount that he will owe us is reducing. So his balance will decrease. How much did he pay us? 20,000. Assets, if they are increasing, they will be debited, and if they are decreasing, they will be credited. Here cash is increasing, so it's being debited, and Sham's balance is decreasing, So it's being credited. Number 10. What is the 10th one? Cash is paid to Mahesh worth rupees 10,000. Okay, so Mahesh is our liability here. See from transaction number 6, Mahesh liability. So what are the accounts that are involved here? One will be Mahesh account and the other will be cash. We are paying money to Mahesh. Liability, Mahesh is our liability and cash is an asset. Since we are paying Mahesh, our liability towards him is decreasing, isn't it? And as we are paying out cash, our cash is also decreasing. Now, when a liability account is decreasing, it will be debited. How much are we paying to Mahesh? 10,000. And cash, when an asset account is being reduced, is decreasing, it will be credited. So Mahesh account debit to cash account. 11. Deposited cash into bank rupees 50,000 for opening an account. Now the accounts involved here are going to be bank and cash. Okay, bank and cash. Bank is an asset for me and so is cash. Here the my bank balance is increasing but my cash balance is decreasing because I am depositing cash no in the bank. When my asset is increasing, I will debit it. And when my asset decreases, I credit it. So cash will be credited and bank will be debited. Number 12. We have withdrawn cash for personal use for 5,000 rupees. Okay, so this is drawings. Drawings and cash. Now what is drawings? Drawings is an expense. In a way, it is drawings by nature. We can say drawings only. And this is an asset. Drawings will affect our capital, okay? But drawings will have opening debit balance. So here, drawings is increasing and our asset is decreasing. To the extent of how much? Drawings कितना है बाबा? 5,000. So 5,000 drawings will be debited and cash, since cash is going out, it's an asset. Asset balance is decreasing. Assets, when they are decreased, they are credited. So debit account, drawings account debit to cash account credit. Number 13, we have withdrawn cash from bank for office use for rupees 10,000. So what are the accounts involved here? One is cash and the other is bank. Now this is for business use, so it won't be considered as a drawing. And by nature, both are assets. Here my cash balance is increasing because I'm withdrawing cash from the bank. And now my bank balance will be decreasing because I have withdrawn from bank. Assets that increase are debited and assets that decrease are credited. That is why cash account debit to bank. Number 14. We have received a check from Sham rupees 5,000. Okay, now Sham is again our creditor. And checks will be deposited in the bank, so it will be added to our bank account. So we will write bank and Sham. Asset. Here, the bank balance of Sham is now our bank balance is increasing because when the check is credited in our favor, our bank balance will increase, and now Sham will owe us less amount of money. So his balance will decrease to the extent of 5,000. Thus, bank account debit to Sham. Number 15. Deposited Sham's check the next day. Okay, so usually until we deposit the check in the bank, it will be classified as a check in hand. By nature, even check in hand is an asset. Now that we have deposited Sham's check in the bank the next day, we'll have the accounts involved will be bank and check in hand. Now both are assets. Our bank balance is increasing and our check is being deposited. So its balance will be written off 5,000, 5,000. Now our next transaction, number 16. We paid Mahesh by check for rupees 10,000. So what is the transaction here? Check in hand and Mahesh. Check in hand is an asset and Mahesh is our liability. So here we have, since we are issuing out a check, our balance will decrease and Mahesh is our liability. We are paying off our liability. Our liability is decreasing. So whenever an asset is decreasing, we credited. How much is the check worth? 10,000. Check in hand, 10,000. Mahesh, our liability, will be debited as a liability. His liability towards him is decreasing. And since our asset is decreasing, assets when they decrease are credited. So the journal entry would be Mahesh account debit to check in hand. Now number 17. We paid salary to staff worth rupees 20,000. Okay. So salary account and cash account. I'm assuming salary is an expense, cash is an asset, expense by nature is a debit, and here it is increasing. So all debits are debit balances when they increase will be put on the debit side. Asset, our asset is decreasing, cash is decreasing since we are paying out cash to pay the salaries. So whenever an asset decreases, we will show it on the credit side. The journal entry would be salary account debit to cash account. 18. Rent paid by check rupees 16,000. Rent to bank. Two accounts are involved, rent and bank. This check in hand and bank, it varies on the situation. For example, in the cases of Sham and Mahesh, we had transactions which were showing like we had another transaction which clearly showed the difference. We had another transaction in which they went and physically deposited the check. That is why we have demarcated. Now here in the case of rent, they are not specifying. So even we will not mention check in hand. We will directly write bank. Rent is an expense and bank is an asset. So our expense is increasing and our asset is decreasing. So, okay, expenses in nature are debit accounts. We will debit the rent. How much is rent? 6,000. And when assets decrease, they are credited. So, rent account debit to bank account. Now, the same thing if I had to use the traditional rule, rent would be classified as a nominal account and asset, the bank would be classified as a real account. Debit all expenses, so 6,000 rupees is debited, and bank being a real account, we debit what comes in and credit what goes out. Now balance is going out from the bank, so bank would be credited. So even as per to the traditional approach, the same entry would come. Number 19 is paid interest on loan rupees 5,000. Okay, interest on loan and cash. They have not mentioned whether it's bank or cash, so I am writing cash. Now this is an expense and this is an asset. Our expense is increasing and our cash is decreasing to the extent of 5,000. Okay. So whenever an asset decreases, we will record that decrease on the credit side, and when an expense increases, we will record that on the debit side. Now, why don't we? I'll quickly. So now I'll quickly classify these accounts as per the traditional method. So we'll classify these accounts if they are personal or real, okay, and which one will be debited and which one will be credited, okay. Capital, cash. Capital is, we know, a personal account, so it will be credited, okay. Cash is a real account. Debit what comes in, credit what goes out. Cash is coming in, that's why 5 lakhs debit. Okay, cash account debit to capital account. Now, number two, we have borrowed money from Naresh. Loan from Naresh will be personal account and cash is a real account. Cash is coming in, so it will be debited. And since personal account rule is debit the receiver and credit the giver. Naresh is giving us money, so he will be credited. Number three, we have purchased furniture for cash. Both furniture and cash accounts, both are real accounts. We debit what comes in, credit what goes out. Furniture is coming in, so we are debiting furniture. Cash is going out, so we are crediting furniture. Now here we have purchased furniture on sale from Delhi Safe. Furniture is coming in, real account rule, so we debit it. Now Delhi Safe will be a personal account because we are owing money to them. Personal account rule states debit the receiver, credit the giver. Delhi Safe is giving us furniture, so we will credit Delhi Safe to 40,000. The next one is cash purchases. Purchases is an expense, so it's a nominal account. Rule of nominal account is debit all expenses, credit all incomes. So purchases will be debited to extent of 15,000, and cash is a real account. Debit what comes in, credit what goes out. Cash is going out, so cash will be credited 15,000. Then the next one is purchase goods from Mahesh. This is a credit purchase. Purchases by nature is a nominal account, so we debit expenses and credit incomes. So we will be debiting purchase account. Mahesh is a liability. He's a personal account because he is an entity. He's a real human being from whom we have bought goods on credit from. And the personal account rule states debit the receiver, credit the giver. Mahesh is giving us goods, so we will credit Mahesh. Purchases account debit to Mahesh account. Then number 7 is sold goods to Karim. This is a sale transaction. We have sold goods on cash. Sales will be a nominal account. Cash is a real account. Cash is coming in, so we will debit cash. And as per nominal account rule, credit all incomes and revenues. Sale is a revenue, so we will be crediting sale. Cash account debit to sales account. Number 8 is sold goods to Shyam on credit. So Shyam is a debtor, and by nature he will be a personal account. Debit the receiver, credit the giver. Now we are receiving, debit the receiver, credit the giver. Sham is receiving goods now from us, so Sham will be debited. Sales again, it is nominal account revenue, it will be credited. Sham is now paying us money worth 20,000. We are receiving money. Money is a asset. Money is an asset. Real account. Money, cash is a real account, so we will debit cash. Sham now is Sham is a personal account and he is giving us money. So we will credit Sham. Next transaction, cash is paid to Mahesh. Mahesh is a personal account to whom we owe money. So we are paying cash to Mahesh, debit the receiver. So we will debit Mahesh towards 10,000 and our cash is a real account, it's going out. So we will credit cash. Number 11, we deposited cash into the bank. Both are real accounts. Debit what comes in, credit what goes out. Money is going into the bank, so bank will be debited. Money is coming, cash is reducing, it's going out. That is why it will be credited. Next transaction is we withdrew cash for personal use for rupees 5,000. Now drawings, it is in nature personal only. Debit the receiver, credit the giver. Debit, owner is only receiving, right? So we will debit drawings and cash Cash is a real account. Debit what comes in, credit what goes out. Cash is going out, cash will be credited. Debit drawings account debit to cash account. Then number 13 is we withdrew cash from bank. Accounts involved are cash and bank. This is again for now for this is for office use. This is for office use. So this will be included in our books only. Accounts involved are cash and bank. Both are real accounts. Debit what comes in, credit what goes out. Cash is coming into the business. Bank balance is reducing. So cash will be debited and bank will be credited. Number 14 is received a check from Sham. Number 14 is received a check from Sham. Check in hand is an asset and Sham is a personal account. Check in hand is a real account and Sham is a personal account. Check is coming in. Real account rule states that debit what comes in, credit what goes out. So the check in hand will be debited. And personal account rule states that debit the receiver, credit the giver. Sham is giving us the money, giving us the check. So Sham's account will be credited. Next transaction is that that particular check is being deposited in the bank. Bank and check in hand both are real accounts. So bank will be bank will be debited and check in hand will be credited because the bank is money is going in because check is going into the bank and the check balance is decreasing here. It's going out. So it will be credited. Number 16, we have paid Mahesh by check rupees 10,000. Okay. So check in hand we're paying to Mahesh. That is a real account. So debit what comes in, credit what goes out. We will credit check in hand. And Mahesh is a personal account. Debit the receiver, credit the giver. Mahesh is receiving the check. So the journal entry would be Mahesh account debit to check in hands. Check in hand. Number 17, we have paid salary to the staff. So what are the accounts involved? One will be salary and then the next will be cash. Salary is a nominal account and that rule states that we debit all expenses and credit all income. Salary being an expense will be debited. I'm not over. Don't disturb me. Then gentleman said, no, I will just pick it up. You give me 10 minutes, get out. Salary is debited. Now cash is a real account. We debit what comes in, credit what goes out. Cash is going out to pay salaries to the employees. So cash will be credited. Next we have rent. Paid rent by check. Same principle. Rent is a nominal account and rent being expense, it will be debited. Bank is a real account. Money is going out. Credit what goes out, so bank will be credited. The journal entry will be rent account debit to bank account. Then the next transaction is paid interest on loan. Interest on loan will be a nominal account. Cash is a real account. Debit expenses, so interest on loan will be debited and credit what goes out. Cash is going out, so cash will be credited. I hope you have understood how to classify accounts under traditional and modern classification systems. So you just need to know these rules and it's not compulsory that you have to use both. You can use the traditional classification if you understand that better or you can even use the modern classification. It's up to you. I have explained both the systems. More commonly, students find the traditional classification better, easier to understand, and so they do, and they follow this. In the next lecture, we will learn how to write a journal entry. Until then, go over these concepts, and if you have any doubts, please message me in the comments. I'd be happy to answer your doubts. That's all for today's class. Thank you. See you in the next lecture.